Austrian economics is astronomy, and what everybody is learning today at universities is astrology, right? It's all a bunch of nonsense. Austrian economics is real economics, and it basically has the focus on supply and savings, and it recognizes that the important thing is not the demand. Demand is infinite. Everybody wants stuff. The key is to produce stuff that people want. And where does production come from? It comes from capital. Where does capital come from? It comes from savings. So the important thing is savings. Savings drives capital investment. Capital investment drives production and productivity, and that ultimately allows consumption. The Keynesians have the cart before the horse. They think that demand is the key, and all their economic policies are designed to stimulate demand, and that's wrong-headed. We don't have to stimulate demand. Demand is there. We need to stimulate production, supply, and the free market does that, and the government interferes with that process. But also, one of the things that the Austrians understand is where the business cycle comes from, that it's not some natural flaw in the capitalist system, that the business cycle, the boom and bust cycle of recession, depression, is a byproduct of central bank artificial manipulation of interest rates. It's when the central banks keep interest rates artificially low, that's a rate that is below what the free market would put rates at. It leads to malinvestments and bubbles, and those bubbles inevitably burst, leading to the recession. And what the Austrians understand is it's the booms, it's these artificial periods of apparent prosperity that are the problem. That's where the mistakes are made. It's the bust, it's the recession that is the helpful process of cleansing the economy of the mistakes that were made during that phony boom. So the conventional wisdom is recessions are bad and the government needs to do whatever it can to prevent them. But the Austrians say, no, recessions are good. We need to allow them. Now, it's not that we want recessions, but once we make the mistake of creating a phony boom, the sooner that boom can bust, the sooner the problems can be fixed. But the way the Keynesians are, they never allow the problems to be fixed, because when one bubble pops, they quickly inflate another one so that we don't have to deal with the pain of correcting the problems. But then we're ultimately going to have to deal with the greater pain of correcting even bigger problems. And I think that's where we are now. We have kicked the can down the road so many years by trying to delay the pain that comes from a real reckoning with these mistakes and malinvestments, that now when we ultimately have to pay the piper, which we will, it's going to be so much worse. And I think, we're very, very close to that happening. I mean, I thought we were close a while ago, and it turned out that there was a little more can kicking that they could do. But if you look at where we are now with massive money printing, inflation blowing up, all the crazy stuff that's going on in the markets, from the meme stocks, to the cryptocurrencies, this has got to be the end of it. The Fed is at the end of its rope, and unfortunately, it's the economy that's going to hang. Well, we should have learned, or there are probably some people that learned the lesson, but not the right people, not the people on Wall Street, not anybody at the Fed, or not anybody in government or academia. But the financial crisis was a byproduct of artificially low interest rates and the mistakes that were made during that environment. And the Fed did that to get us out of the recession that followed the bursting of the dot-com bubble, which again was inflated by the same wrong-headed policies. And when that bubble popped, the Fed doubled down on those mistakes and inflated the housing bubble. It was quite obvious to me what the Fed was doing wrong and what the consequences would be. I warned about the coming financial crisis for years. And not only did I warn about the crisis that was coming and why, but what the government was going to do in response. And of course, I was right again. The government tripled down on its mistakes. Instead of learning from them, like, oh my God, we kept interest rates artificially low, and too much money was borrowed to do non-economic things. We had too many people overpaying for houses. We had people were consuming more than they should have because they thought they were richer than they were, because they were basing their wealth on these inflated asset prices that only existed because of the artificially low interest rates. So we totally distorted the economy. We created this massive bubble that was inevitably going to burst, and now we're having to deal with the consequences of all the losses from all the loans that never should have been made and never would have been made, but for our mistakes. Instead of learning that lesson, they just repeated the mistakes on a bigger scale. They didn't just raise rates to lower rates to 1%. They went all the way down to 0, and they left them there for 8 years instead of like a year and a half. And they never normalized rates. The highest they got was 2% or 2.5% before going right back to 0. And they threw quantitative easing into the mix, something that they didn't even do during the housing bubble days. They went all in and did that after that bubble popped. And so they have inflated today a bubble that is larger than the stock market bubble and the housing bubble combined. And it has done far more damage to the economy than either of those two bubbles. And therefore, the consequences when this massive bubble pops are far more severe than anything we experienced during the Great Recession that followed the bursting of the housing bubble. What the government is doing now with inflation is exactly what I predicted they would do, because first they deny that there's inflation, and they did that for a long time. Then they say, okay, we have inflation, but that's a good thing because this is what we need. We didn't have enough inflation, so thank God we've got inflation. Then they start saying, well, okay, it's a little higher than we really want, but don't worry, it's just transitory. And initially, transitory means temporary, like, oh, the price hikes won't stick, right? After we get back to normal, prices will go back down to normal. Then they change the definition of transitory to mean permanent, meaning that, well, what's transitory are not the price hikes, they're permanent. What's transitory is how much longer they're going to be going up at this pace, which they don't even know. So they keep changing their tune and moving the bar, but they're still pretending that if inflation ever really became a problem, even though it already is a huge problem, but they're claiming if it ever became a problem, well, they have the tools to fix it, right? Which maybe they do, but they would never actually use them, because if the Fed was willing to use its tools, it would have already used them. The reason it's not is because it can't, and so it won't. And eventually, what I think the Fed is going to come out and say is, you know what? Inflation is a lot more than 2%, whatever it is, 4%, 5%, 6%. But you know what? Get used to it, because it's going to be with us for a long time, and it's okay because it's better than the alternative. It's the price we pay for prosperity. It's the price we pay for a strong labor market and income inequality and a Green New Deal. And whatever it is, they're just going to say we have to accept high inflation as, a fact of life. That's what's ultimately coming.